CNBC-TV18, embarking on a quarter century of excellence.
Hello and welcome to the CNBC-TV18's Mumbai studio. I'm Sonal Bhutra. You're watching MF Corner. This is the last mutual fund corner for 2023 and it has been a very interesting year as well. So before we get to today's topic, today's conversation and the guest, let's talk about what went by in 2023. Retail investors had a good year on the stock markets, but 2023 was also the year the mutual fund space took off its foot off the gas when it came to new fund offers and the other aspects of the mutual fund industry as well. Shivani Bajaj detailing the trend and the reasons behind it. Shivani.
Well, mutual funds in India have had a splendid run over the last few years, and when 2023 began, it was expected that this year would be no different. To a large extent, it was not. As of November end, MF inflows have come in at 49 lakh crore rupees, with 40% going into equity funds. The difference this year, however, is the number of new fund offers that were launched in this year. Now, remember, NFOs are how fund houses typically cash in on new trends and opportunities. So, the fact that only 191 new fund offers were launched this year is telling. I say only 191 because this number is less than the 228 NFOs launched in 2022. 2023 has also seen relatively lesser money coming into mutual funds through NFOs. 53,000 crore rupees, which is 13% less than 62,000 crores raised through this route in 2022. Now, experts and industry watchers say that one of the biggest reasons for the significant decline in the number of new launches this year is the change in debt taxation. The Finance Act of 2023 removed the benefit of long-term capital gains tax for debt mutual funds. Essentially, it said that gains made from mutual fund schemes that have less than 35% allocation in equity would be taxed as short-term capital gains, so now at 30% instead of the earlier 10%. This would apply irrespective of the period for which the units were held. In effect, what it did was it turned investors away from such funds, specifically the target maturity funds. TMFs had seen a surge in popularity in the previous 2 years because they were open-ended funds and offered a fixed rate of return. Now, to give you a sense of their popularity, between January and March 2023, 31 new passive funds were launched and all of them were target maturity funds. However, once the new tax rule kicked in from the 1st of April, guess how many TMFs were launched? Only 3 after April till December 1st. Of course, new passive funds continue to be launched, but they were mostly in the equity space. Overall, in 2023, 50 new index schemes were launched and these together cloaked inflows of 2,500 crore rupees. In contrast, in 2022, 84 index funds were launched, most of them target maturity funds, and inflows in these schemes came in at 11,235 crore rupees. To be fair, through the slowdown in debt mutual funds has been the only big bump in the road for mutual funds in 2023. In all, thanks to the bull run in the equity markets, business has been good. There were 45 equity NFOs in all, raking over 30,000 crore rupees by November end. Sectoral and thematic funds saw the most buzz between January and the end of November. 25 new sectoral and thematic funds were launched, garnering around 13,000 crore rupees in their NFO period. The big draw, however, were funds focusing on infrastructure and public sector undertakings. Several themes like infrastructure, PSU theme and banking sector were played via business cycles funds and quant funds. This interest has been rewarded as well. Thematic funds have offered year-to-date average returns of 54% to investors, and infrastructure funds have given average returns of 42% year-to-date. New fund offers also were launched in diversified categories like multi-asset funds and multi-cap funds. They have also continued to attract investors in 2023. Now, 6 new multi-cap funds were launched, garnering around 7,200 crore rupees. It also saw 6 multi-asset allocations funds, NFOs, garnering over 6,500 crore rupees in 2023. While multi-cap funds offered year-to-date returns of 31%, multi-asset funds also offered close to 20% returns to investors. So overall, the mutual fund industry has had a good year and, barring the jolt from the new taxation rules, has been riding high on the bull run and giving investors fatter wallets.
Shivani, thank you so much for all those details. So that is the mutual fund picture in 2023, but there's a lot more to discuss. What's the outlook and what did the new fund offer picture really look like in 2023? On that note, let's welcome Kaustubh Belapurkar, Director of Fund Research at Morningstar Investment Advisor. Kaustubh, always a pleasure speaking with you. Thank you so much for joining us today. And you know, we have discussed in the past as well. There have been a lot of NFOs, the funds raised as well this year, but it has been lower than 2022. What do you make of this particular trend? Do you think this is something that will continue?
Firstly, hi Sonal, and thanks for having me in the show. I think very exciting time to be talking about this. End of the year, we've seen, like Shivani very rightly laid out, that there's been a lot of buzz in the industry, and we've seen 191 funds. I'm just putting things into perspective. That's one new fund launch every alternate day, right? So while the number might have come down, it's still a staggering number from the perspective of the overall fund launches that we've seen. Obviously, when I think about the flows that these have garnered, they're about 53,000 crores, again, lower than last year. In fact, significantly lower than what we saw in 2021, where we saw some mega new fund offerings from, in certain categories, which collected north of 10,000 crores. That's not necessarily happened this year, but still a pretty significant chunk of almost 15% of the overall flows that have come into the industry, which is about 3.14 lakh crores for 2023 year-to-date November. About 53,000 crores, about 15% has actually gone into through the NFO route. So that's, just putting things into perspective, it's still a pretty staggering number from an industry which is obviously growing. But I think if you just break this down, right, there's some interesting trends that you would see. Because the one thing that a lot of people thought was that after SEBI's categorization came in existence in 2018, new fund offers would kind of really slow down or dry up. But I think since COVID of 2020, we've seen about 600 plus fund launches, which have collected about 2.7 lakh crores in this about 4-year period, right? So what's really happened? What are some of the levers behind this, right? So a couple of things. One is there have obviously been new asset managers that have come to the entered the space. So we had a few new folks enter this year, which they've obviously been launching their strategies. There have been some that launched, foray into the market or took over existing asset management businesses, a couple of years ago, and they're beefing up their product portfolios. But also, what's also been happening is, existing large, well-established asset managers have also been growing their product bouquet, right? So it could be, like we spoke about, passives, both on the equity and the fixed income side, where there have been this plethora of fund launches, but also on the thematics space, where we've seen a fair bit of activity over the past couple of years. So I think just putting things into perspective, I do believe that this activity or this could continue in the coming years, because obviously we'll have newer and newer players coming in the asset management industry. There are quite a few already lined up, and obviously asset managers will find pockets of opportunity where they believe they don't have a product available, and they would look to launch funds. So I do believe this would continue. The industry is growing, right? So the investor base is growing. So that's obviously a positive sign.
No ways was I saying that 191 is less. As you said, it's one alternate fund yes. every other day, right? So there is, of course, the pie keeps on growing, just the base also is becoming bigger. But let's break it down. You did provide us a very informative table earlier today. We had 50 index funds being introduced to the market this year. This is lower than 2020 and 2022. But what do you make of the passive investing, which is still the hot topic? How do you see this particular space growing?
Yeah, great question. I think, Shivani in the earlier conversation really hit the nail on the head. A large part of this passive investment pie, especially in 2022 and even this year, was driven by the target maturity funds, right? Which was a very exciting category that came about, where you could invest in a fixed income fund, with reasonable sort of certainty of what you would make, given that, if you stayed until maturity, as opposed to having an interest rate risk that you would see in typical duration funds. So that really, was quite popular with investors. Obviously, with the new taxation laws kicking in, those have dried up, since, April of this year, right? So that's happened.
Okay, all right. It looks like there is some technical glitch, but of course, as Kaustubh was saying and as Shivani also mentioned, it was the target maturity funds which did see an impact because of the taxation norms that changed in the month of March, and that is something that could have impacted the flows as well. But Kaustubh, we have you back. Please go on.
Yes. Sorry. Yeah. So I was saying that, the equity funds, right, that we've seen a lot of equity passives also being launched. And these have been across the board. So you have broad-based market cap indices, be it a large cap, mid cap, small caps, index funds and ETFs. But you've also had a lot of sectoral and thematic index funds or funds being launched. And you've also had a bunch of what we call the smart beta indices, which kind of, be it a value index or a momentum index or an alpha index. So it's been, I think, a whole host of launches. But when you look at the overall flows that have come into this, because these are more, especially the smart beta, the sectoral ones, which are more niche products, which are not necessary that every investor would find an opportunity or find a place in his or her portfolio. So the flows of the assets that are there are obviously limited. But yes, the passive industry pie is growing. But again, just going back to that conversation, we think both active and passive are great opportunities from an Indian context. They both can coexist, different strokes for different folks. So it really depends upon what fits into an investor's portfolio. And it's good to see so many passive options available, especially on the broader base indices where, you can buy a cheap passive fund. If you don't have the wherewithal to buy an actively managed fund and stay invested, here's a good option for you to buy the market and just stay invested. So, I'm glad that, there's so many options available. Obviously, sometimes it may get a little overwhelming, but, having options is good.
You're right. It does get overwhelming at times, but that's why we have experts like you on the show as well to make sense of so many options and so many new AMCs which are coming to fore as well. But this was also a year of a lot of NFOs in the flexi-cap, multi-cap, multi-asset funds. Is this a way one can actually start investments? What are some of the risks associated with this one? Because since the debt taxation change as well, there was a lot of focus on hybrid or multi-asset funds to get exposure to a lot of asset classes.
Yeah, absolutely. So, when I think about flexi-cap funds from an equity space, and in fact, when you look at also the data that's shown, a lot of the new asset managers that have launched, one of their first go-to-market products has actually been a flexi-cap fund. Because, broadly, when you think about an investor's portfolio construct, and when you would see a lot of the flexi-cap funds would traditionally be a large cap bias portfolio with some element of a mid and small cap exposure, which is great because that's where you would expect a large part of investor portfolios to be at in terms of the market cap allocation within the equity bucket. So, rather than an investor going out and picking individual funds, large, mid, and small, another way of doing it is just buying, a couple of flexi cap funds, which could, serve the purpose of building his or her equity exposure, right? So that's why flexi cap funds are definitely, I think, a very popular sort of medium that's definitely happening. Multi-cap, slightly different reasons, obviously, because it's a more, mid and small cap, at least 50%, given SEBI's norms, will go into mid and small caps. Obviously, there were significant number of asset managers that didn't have multi-cap funds are now kind of filling in that product gap in their product bouquet by launching multi-cap funds. And we've seen this, since the last couple of years, since 2020, when this category was introduced. Multi-asset, interesting, and you rightly alluded to it. Given that debt taxation has become, what it is in terms of, the investor's tax rate, you can also play, your debt portfolio through a multi-asset fund, which will not only buy fixed income, but it'll buy equities. It could buy at least another asset class that could be gold or international equities. And also, if it holds 65% in equities, it gives you a beneficial of better taxation. So yes, that's one of the reasons where you've seen, again, a whole host of, sort of multi-asset funds being launched. And, you've seen about 20,000 odd crores that have come in existing funds, plus NFOs, which is about 6,500 crores in the multi-asset NFOs. The only sort of, pinch of salt that I would give to investors is that, remember, these hybrids or multi-asset funds are never a one-size-fits-all solution for every investor. You have to consider your own unique circumstances in terms of what are the demands of your portfolio's asset allocation. They could be a part of your portfolio. They don't necessarily need to be the only fund in your portfolio, because not every investor, like I said, is going to have exactly those asset allocation needs.
Okay, so different strokes for different folks. That's why we need to have different parameters defined before we invest in anything across the asset class. But Kaustubh, we have to slip into a quick break. On the other side, we'll continue this interesting conversation and understand more about new fund offers and a lot more.
CNBC TV18, embarking on a quarter century of excellence.
Welcome back. You're still tuned into MF Corner. We still have with us Kaustubh Belapurkar from Morningstar Investment Advisors. We are talking everything about the NFO rush that we saw this year and what really stands out. Well, you know, Kaustubh, NFOs and funds of funds investing overseas has come down in 2023. What are the trends suggesting? Has it got anything to do with the tax collected at source rule, so there's less interest in this particular thing? Or is it because of many of these funds reaching the LRS limits? Or is it just general market trend?
Sure. So a couple of things, Sonal. So, as far as my understanding, TCS will not apply to these because, the Indian fund, I mean, these are Indian domicile funds. The investors actually buy in Indian rupees. So yes, these funds are subject to the $7 billion limit that's been put in. And, that is the bigger challenge, where obviously, a lot of those, I mean, we're close to kind of breaching that, and a lot of funds had shut in the past and then were only allowed to open, given certain circumstances. So that's been one of the reasons why there haven't been too many fund launches on this space. But even otherwise, when you think about investor behavior, right? So what we saw in the year of 2023 was there was actually some money that was pulled out from global funds that were investing overseas, and predominantly the reason being the poor 2022, which markets like the US had, right? Where obviously, the markets, especially the FANG stocks, corrected quite sharply in the year of 2022, although they've obviously rebounded equally sharply in 23. But, a lot of investors did get perturbed by this volatility, and, they did remove some money. And I think my advice to a lot of these investors is that, look, international investing is a great way to diversify, to take exposure. And, I would recommend that you should always have exposure at any point of time and not really try to time your entry and exit into these funds, because it's very hard to call. Like we talk about cyclicality of markets and sectors, that also happens. 22 was India was relatively, the broader markets were great as compared to the US markets. 23, we've obviously seen a slightly different run, especially in the technology stocks for the US. Obviously, our mid and small caps have done well, but the broader market is probably lower than what the US has done. So I think the broader context is that, look, stay invested. International diversification is good as and when you have opportunities. But yes, the number of new fund offerings have been limited. But I think while we don't have a very, very large bouquet of funds, I think there's a reasonable sort of menu card for investors to look at from, at least starting their international investing journey, obviously limits permitting.
Okay, all right. So in that case, Kaustubh, should investors look at new NFOs or stick to the existing ones? Which is a better strategy?
To be honest, in most cases, it's just to keep it very simple. I know there's always that excitement of something that's new and shiny, and it's human nature to gravitate towards that, right? But I think in most cases, investors are best served by investing into a fund which is well established, got a good long-term track record, so that the way it's being managed and really the way it fits into your portfolio. So I think when you think about an NFO, you need to think about a couple of things. One is, what is it that it's bringing to your portfolio? Is it unique, or is there already an established alternative that's available? But more importantly, you also need to think about is that, do you need that kind of an exposure in your portfolio? Because many times what happens is, because there's something new and that's available, you hear about it, you read about it, and you want to invest in it. But maybe that's not the right thing for your portfolio. For instance, there have been so many of these thematic fund launches that have happened in the past couple of years. They may not be suitable for all investors because, they're really targeting a particular sector or a particular theme. And we spoke about cyclicality of markets. A lot of these can also go through periods of cyclicality. And I give this example because it really drives home the point that technology is a sector which had done exceedingly well in the years of 2020 and 21. Most of the investor money came into tech funds in the year of 22, when the technology sector had already started correcting. So those investors that came in, they were too late to the party, right? Because they looked at the past returns and came in. So I think that's what I want to tell investors, that always think about the suitability of that fund in your portfolio. And if there is a well-established alternative already available, I would always think about choosing that versus a new fund that's coming in, because you don't know how that's going to pan out. So I think that's, yes, if there's something very different that comes in, then potentially yes, and it fits in your portfolio, sure, why not? But always think about these particular aspects when you buy into a new fund.
That's very helpful. And you spoke about if there is anything different, you could look at it. Are there any NFOs which have stood out for you this year? Something you think are worth looking at?
Yeah, so I think a couple, again, these are not recommendations, obviously, but just personally what I thought were slightly interesting. So there was, this is probably coming from a very personal space. So there was a defense sector fund that came out, right? And being a 4G kid, it was very nice to see that here's a fund that's really investing in defense stocks, kind of the whole Make in India, getting into stocks that are actually building a lot of these capabilities now for the Indian forces, indigenously, obviously, which in the past, we've always relied on technology and sort of all of this from, be it Britain or Russia or other countries, right? So yes, that was an interesting trend, but obviously that's a very, very personal choice. The other few interesting sort of choices, funds NFOs that I saw, there was a US Treasury bond sort of fund that feeds into ETFs. Now, we've traditionally seen exposure that's being taken by funds into US equities. We all know that even the US bond yields have been at elevated levels given where their rates have been at. That's if you want to take exposure into US govies at the elevated levels, that could be a potential sort of interesting fund that was recently launched. And there was also another one which kind of expanded the space because like we spoke that there have been a lot of US equity funds, there have been a lot of global funds, but there was one fund that was developed markets ex-US, right? So which basically looks at all the other developed markets from Europe, from the Asia Pacific, because a lot of US exposure already resides in investor portfolios. So yeah, I think couple of these funds were kind of interesting from my own perspective, which were probably slightly different from what we've seen in the past.
Okay, all right, Kaustav, we have a lot more questions, but unfortunately completely out of time. But thank you so much for joining us today and talking to us about the year that was when it came to NFOs in the mutual fund industry, and have a great year ahead as well. Okay, with that, we'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.
CNBC TV18, embarking on a quarter century of excellence.